Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on Friday, August 18th, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's talk about that. Tonight, we'll delve into the SEC's potential nod to Ether Futures ETFs, possibly a game changer for the crypto industry. We'll also discuss the storm brewing in Canada around stablecoin trading and the challenges faced by Coinbase. Then we'll cover the Federal Reserve's action against Farmington State Bank and its implications for the future of banking and crypto. Tether's decision to depart from Bitcoin Omni layer is another significant development that we'll dissect, shedding light on the evolving crypto landscape. We'll also turn our attention to a crucial legal battle involving Tornado Cash, highlighting the ongoing tension between government regulators and the crypto world. Finally, the spotlight will be on MasterCard's steps towards understanding and developing central bank digital currencies, marking a pivotal point in the financial world. The U.S. Securities Exchange Commission is on the verge of a significant move in the cryptocurrency space. Reports suggest that the SEC is gearing up to approve the first exchange-traded funds based on Ether futures. This development has been eagerly anticipated by the crypto community, especially given the increasing interest in Ethereum. Several firms, including prominent names like ProShares, Volatility Shares, Bitwise, and Roundhill, have submitted applications to the SEC to launch these ETFs. The buzz is that the regulator might not obstruct these applications, signaling a potential shift in its stance towards cryptocurrency-based financial products. While the exact timeline remains uncertain, insiders hint that approvals could roll out as early as October. This move by the SEC is not entirely unexpected. The regulatory body has previously permitted trading in ETFs holding Bitcoin futures. However, the crypto community is still awaiting the SEC's decision on ETFs that would directly hold Bitcoin. Major financial institutions, including BlackRock, have shown interest in creating such products. The potential approval of Ether's Futures ETFs is a significant win for the crypto industry. Ethereum's native token, Ether, is the second largest cryptocurrency by market cap, right after Bitcoin. The approval would provide investors with a new avenue to speculate on Ether's future price movements without directly investing in the crypto. This development underscores a gradual shift in the Commission's perspective on cryptocurrency products. Historically, the SEC has been cautious, often citing concerns about price manipulation, insufficient liquidity, and the overall volatility of the crypto market. Their apprehensions have been particularly pronounced regarding Bitcoin-based ETFs, leading to a standoff with the crypto industry on several occasions. However, the potential approval of Ether Futures ETFs suggests a more accommodating stance, at least towards certain types of crypto products. This change could be attributed to the increasing interest from institutional investors. Valkyrie has also thrown its hat in the ring, filing an application for an Ethereum Futures ETF. Their proposal is particularly interesting as it outlines a specific limit on the ETF's investment in the ETF futures contracts, adhering to position limits set by the Chicago Mercantile Exchange. The SEC's potential green light for Ether Futures ETFs says something about the growing influence and acceptance of cryptocurrencies in the mainstream financial world. While challenges do remain, and the SEC's full embrace of the crypto industry is still a work in progress, these developments are promising signs for the future of crypto, both in the US and globally. While the future of Ether ETFs shines brightly, our neighbors in Canada face a storm surrounding stablecoins. But before we navigate those waters, take a moment to turn on notifications so you're always in the loop. Coinbase announced its decision to suspend trading of three stablecoins, USDT, DAI, and RAI, but only for its Canadian users. This suspension will take effect on August 31st. The exchange communicated this decision to its users through an email, emphasizing that they consistently monitor assets on their platform to ensure they align with their listing standards. Following this review, they've chosen to halt trading the mentioned stablecoins specifically for the Canadian market. This move by Coinbase comes shortly after the exchange expanded its services in Canada. Earlier in the week, Coinbase had officially launched in the country, integrating with local banking systems and actively collaborating with regulators. The exchange had previously commended the Canadian authorities for their clear and engaging approach to cryptocurrency regulations. However, Canada has been tightening its regulations around cryptocurrency exchanges this year. This has exerted pressure on several exchanges and stablecoins operating within its borders. Notably, Binance exited the Canadian market in May. Additionally, Crypto.com had preemptively delisted USDT from its platform in January, foreseeing the introduction of stricter regulatory measures. Now, it seems to me the regulatory landscape in Canada is undergoing significant changes, and major exchanges are having to adapt swiftly. Coinbase's decision to suspend stablecoin trading, especially after its recent expansion into Canada, underscores the challenges crypto businesses face in navigating regulatory waters. Now, this may raise concerns about the future of stablecoin trading in Canada and potentially other regions. Stablecoins, especially USDT, have been pivotal in the crypto ecosystem, providing a bridge between fiat and digital currencies. Their suspension from major exchanges could impact trading dynamics and liquidity. Banking and crypto are mingling in more ways than one, especially in the heart of America. If you appreciate these deep dives, don't forget to follow the Overnighter. Farmington State Bank was previously known as Moonstone Bank. Back in 2022, they secured approximately $11.5 million from FTX's affiliate, Alameda Research. The Federal Reserve Board, in collaboration with the Washington State Department of Financial Institutions, has now initiated an enforcement action against Farmington. This action is as a result of the bank's undisclosed shift in its business strategy in 2022. The bank did not inform the Federal Reserve of its intent to focus on digital banking and digital assets. The enforcement ensures the bank's operations will conclude in a way that safeguards its depositors and the Deposit Insurance Fund. This action also restricts Farmington and its holding company, FBH Corporation, from distributing dividends or capital, using up cash assets, and undertaking certain operations without supervisor approval. Farmington had previously announced its decision to withdraw from the cryptocurrency sector to revert to its foundational role as a community bank. However, the enforcement action indicates the bank's involvement in digital asset-related activities. This includes facilitating the issuance of stablecoins for an undisclosed third party in return for a share of the mint and burn fees. Farmington, based in Washington, had intentions to transfer its loans and deposits to the Bank of Eastern Oregon. The enforcement action and the bank's decision to exit the crypto space did not explicitly mention the cryptocurrency exchange FTX, which filed for bankruptcy in November of 2022. This enforcement is the latest in a series of actions by federal regulators against banks associated with cryptocurrency firms following the collapse of FTX. The enforcement action against Farmington highlights the increasing scrutiny and regulatory challenges faced by banks and financial institutions involved in the cryptocurrency space. The bank's undisclosed shift towards digital assets, especially after receiving significant funding from a major player in the crypto industry, raised concerns about transparency and regulatory compliance. The Federal Reserve's move serves as a cautionary tale for other banks and financial institutions considering a foray into the digital asset space. It's a warning. The system is afraid, and it's gonna strike back. The crypto industry's rapid growth and the potential lucrative opportunities it presents can be enticing for traditional financial institutions. However, as seen with Farmington, such ventures come with their own unique set of risks and challenges. The broader implications of this enforcement action will lead to increased skepticism and hesitancy among banks to engage with the crypto industry, which is the point. It also emphasizes the need for clear regulatory frameworks and guidelines to ensure that both traditional banks and crypto firms can coexist and operate within the bounds of the law. Any distrust towards governments and central banks, especially in the context of cryptocurrency, is further exacerbated by such events. Tether's recent decisions are shaping the crypto landscape. Keep supporting my content by sharing it with at least one person who might be interested. And we've already spoken about Tether tonight. They've made a significant decision that has caught the attention of the crypto community. The company announced it would no longer issue its stablecoin on the Bitcoin Omni layer. This decision also extends to other versions of Tether, especially those on Bitcoin Cash and Kusama. The primary reason cited for this move is the dwindling interest from users. The Bitcoin Omni layer is a smart contract system built atop the Bitcoin blockchain. It was initially known as Mastercoin and was introduced to the crypto world in July 2013. That's 2 years before Ethereum made its debut. OmniLayer Tether was the first stablecoin to be launched on the system in October 2014. It rapidly rose in popularity, surpassing other early stablecoins like BitUSD and NuBits. Tether's announcement emphasized the historical significance of OmniLayer Tether in the crypto landscape. Built on Bitcoin, the OmniLayer played a pivotal role in Tether's early days. The team behind Tether expressed gratitude for the contributions and innovations the OmniLayer brought to the crypto world. However, challenges arose due to the absence of popular tokens on the Omni layer and the increasing availability of USDT on other blockchains. This shift in preference among exchanges led to a decline in USDT Omni usage, prompting Tether to stop issuing it. However, Tether hasn't closed the door entirely on the Omni layer. The company mentioned that it might consider reissuing the Omni layer version if there's a resurgence in its usage. They also revealed plans for a new Bitcoin smart contract system named RGB. Once this system is operational, Tether intends to reintroduce its stablecoin on it, bringing Tether back to the Bitcoin blockchain. Tether's move away from the Omni layer is a reflection of the broader market dynamics. The competition among stablecoins has intensified in 2023, with giants like PayPal introducing their versions challenging Tether's supremacy. Furthermore, the regulatory environment in the United States has been a significant factor in influencing the crypto market. The SEC's classification of several coins as securities has added a layer of uncertainty. Bitcoin, however, seems to be in a different category, with multiple spot ETF applications being filed recently. The regulatory scrutiny on major exchanges has also impacted trading volumes. Both Coinbase and Binance face legal challenges, with the latter also under investigation by the Department of Justice. So while Tether's decision might seem like a minor shift in the vast crypto universe, it's a reflection of the larger forces at play. The crypto markets are currently witnessing reduced liquidity, trading volume, and volatility. Factors ranging from regulatory challenges to market dynamics are influencing these trends. Legal challenges continue to shape the boundaries of the crypto world. So if you find these analyses valuable, drop us a comment below. A group of crypto proponents, backed by Coinbase, recently faced a setback in their legal battle against the U.S. Treasury Department. Their contention was that Treasury had overstepped its bounds by sanctioning Tornado Cash. Tornado Cash is a service designed to anonymize crypto transactions. Judge Robert Pittman, presiding over the U.S. District Court for the Western District of Texas, delivered a verdict that may have far-reaching implications for the crypto world. Tornado Cash is not just a service. It's an entity with a vested interest in smart contracts. The judge's decision emphasized this, stating that Tornado Cash is indeed an entity, including the decentralized autonomous organization that oversees it. This DAO, through its voting members, have shown a commitment to a shared goal, much like shareholders in a corporation. The judge dismissed several arguments from the plaintiffs, including the notion that Tornado Cash doesn't possess a property right in the smart contracts being designated. The Treasury's move to sanction Tornado Cash was based on allegations that it was a primary tool used by malicious groups, that groups such as North Korea's Lazarus Group used it to launder stolen crypto. This decision was met with significant backlash from the crypto community. Coin Center filed its own lawsuit shortly after the one backed by Coinbase. The implications of this lawsuit are profound. The Treasury's decision to sanction Tornado Cash and the subsequent court ruling highlight the ongoing tension between the government regulators and the crypto industry. The crypto community tends to view such actions as overreaches that stifle innovation and infringe on rights. Tornado Cash's designation as more than just software, but an entity with rights and interests, sets a precedent that could shape future interactions between regulators and crypto platforms. Coinbase's chief legal officer expressed the company's intent to support an appeal. His sentiments resonate with many in the community who believe that the fight for Tornado Cash is a fight for the broader rights and freedoms of the crypto world. As the battle continues, it serves as a testament to the ongoing struggle between the decentralized promise of crypto and the centralized control of government entities. The outcome of this case and others like it will undoubtedly shape the future of crypto in the global economy. Traditional financial giants like MasterCard are taking keen interest in the digital realm of CBDCs. Make sure to like, follow, and subscribe to stay ahead of the curve. MasterCard took a significant step towards the development and understanding of central bank digital currencies. The company's formed a partnership program with 7 leading blockchain and payment technology providers. This initiative aims to shed light on the potential advantages and challenges of CBDCs. Interestingly, 93% of central banks are currently exploring this technology, indicating its growing significance in the financial world. The MasterCard program is set to collaborate with companies that have already made strides in CBDC development. Participants include Ripple, which has launched a dedicated CBDC platform, and Consensus, a software firm involved in multiple CBDC projects. Another participant, Fluency, offers tokenized asset solutions and is engaged in 23 CBDC initiatives. Other partners comprise Giseke and Devrient, which has collaborated with the central banks of Ghana and Thailand, Idemia, known for offline payments and its involvement in a Japanese CDBC project, Consult Hyperion, which also specializes in offline payment solutions, and institutional custody platform Fireblocks. MasterCard's involvement in the CDBC space isn't new. The company has shown consistent support for CDBCs, having participated in projects with esteemed institutions like the Bank for International Settlements and the New York Federal Reserve Bank. They've also collaborated with individual central banks. Their commitment to the CDBC realm is evident in their previous endeavors, such as launching a prepaid card for Bahamians to utilize the nation's CDBC, which was the world's first. However, the global landscape for CDBCs is vast and varied. According to the Atlantic Council's CDBC tracker, 130 countries, which account for 98% of the global GDP, are researching the possibility of CDBCs. 11 countries have already launched their own CDBCs, with most of them located in the Caribbean, except for Nigeria. Additionally, 21 countries, primarily in the Middle East and in Asia, are currently piloting a CDBC. But it's not all smooth sailing. Concerns about privacy and the potential for state control over financial freedom have cast shadows over the CDBC movement. U.S. Congressman Tom Emmer introduced the CDBC Anti-Surveillance Act earlier this year, aiming to prevent unelected Washington bureaucrats from depriving Americans of their financial privacy rights. Similarly, Republican Representative Warren Davidson has voiced concerns, stating that money should not be programmable by a central authority. So, while CDBCs represent a significant shift in the world of finance and have the potential to revolutionize the way we perceive and use money, they also bring forth challenges and concerns that need addressing. With giants like MasterCard leading the way, the journey of CDBCs is undoubtedly one to watch closely. So, what happened? The US SEC is gearing up to potentially approve the first ETFs based on Ether Futures, signaling a warming stance towards cryptocurrency-based financial products. Coinbase, shortly after launching in Canada, has made the bold move to suspend trading of 3 key stablecoins, reflecting the tightening regulatory environment in the country. Farmington State Bank faces enforcement action from the Federal Reserve Board due to undisclosed shift towards digital assets, cautioning other banks eyeing the crypto space. Tether decided to cease issuing its popular USDT stablecoin on the Bitcoin Omni layer, pointing toward the shifting preferences and needs of the crypto market. A legal battle backed by Coinbase against the U.S. Treasury Department over the sanctioning of Tornado Cash faced a setback in court, setting a potential precedent for future crypto-related legal issues. MasterCard is leading the charge towards understanding CDBCs by partnering with significant blockchain and payment tech providers as the world watches the CDBC landscape evolve and expand. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.